In this video, we're going to talk about Palantir trading under the ticker symbol PLTR. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Palantir is a data analytics company founded in 2003 and is currently headquartered in Denver, Colorado. It develops software platforms and applications to better understand the data flow and optimize the operations. Palantir has the appeal for the market because it does have a solid reputation built in a relatively long time, has a lot of established relationships with major federal agencies, and obtained many long-term contracts as a result. It operates in many sectors including automotive, legal, natural resources, and finance. The platforms it has developed are Palantir Gotham and Palantir Foundry. The market cap of Palantir is currently at $36 billion, and the enterprise value is at $44.96 billion. The market cap is the price tag financial market is willing to evaluate Palantir stock at, with consideration to its future potentials as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets when all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there are exceptions. For example, the company may be highly leveraged, or its valuations may be modified, or the results disappointed the market consensus. The quick ratio of Palantir is 4.13. The current ratio is also 4.13, and the debt over equity is 0.12. In other words, Palantir is currently financing most of its operations through 1. Its operating business, so the revenue, and 2. Equity. The average trading volume of Palantir has been 35.88 million shares, and the daily volumes have been 42.09 million shares, 44.3 million shares, and 33.9 million shares. The 1-year beta of Palantir is 1.19. Its 52-week high is $45, and its 52-week low is $17.06. Now, let's also talk about the options market for Palantir. In terms of volume and open interest, the options market seems to favor the call side. Generally speaking, the put options mean that the market expects a pullback, and the calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $18, $18.50, and $19. Palantir has been having a fairly challenging sequence of events recently, partially because it published quarterly results that were below people's expectations in one specific area, and that is the growth in public contracts revenue. This has caused some analytics to reevaluate Palantir's value and consequently triggered a wider redistribution of risks and exposures in the market participants' portfolios. Usually, this may not have that much of an impact, but Palantir is a major public company with material institutional holdings. What I'm saying is, the valuations and analysts' opinions do have a significance for those who handle money on a large scale. This may sound a bit weird, but portfolio managers do listen to the opinions of what others think and will decide to modify their exposures and decisions in specific areas as consequence. From my personal observations, sometimes those buying and selling decisions happen almost in a mechanical way because they've heard that others believe that the stock is going to do well or not. It may not have anything to do with their own personal opinion, but as an institution, they may have to do this. In this case, the recent sell-off may have been created by the fact that institutional portfolio managers have seen that analysts have changed their consensus about Palantir. It's simple as that. And this, coupled with the relatively high valuation that the stock has, to determine that they don't really want to carry that much exposure in this company. In other words, many sold because they think others may change their opinions about Palantir. Now that we have talked about institutional shareholders, let's also talk about something that we as retail traders face. Palantir is valued based on future projections that were determined on a very favorable environment, and I would argue that this environment may get more challenging in the medium term. I don't believe that Palantir necessarily is a bad business or has a deficient business model, but its current valuation already puts so much hope, and I would say even hype, on the shoulders of this company, that there is a very compelling case for market to take a break on the buying spree. With that being said, let's also take a look at the fundamentals themselves. Palantir has a software-based business model with deep and long-term relationships with various public and private sector clients. I think that in the long term, Palantir will make its place and establish a more permanent and tangible presence in the economy of the future. For that reason, I think that the long-term recommendation should be positive and to adopt an overall bullish view. However, for that reason, I think that the long-term recommendation should remain positive and that we should adopt an overall bullish view on Palantir. However, we should definitely increase the time scale of this investment from months to years, or maybe even above a decade. Our portfolio should be ready for the scenario that Palantir may pull back by up to 30% more from where it is now. It doesn't mean that a company will necessarily do this, and I don't currently see any signs that it will, but it's a matter of protecting our capital in an uncertain market environment. My suggestion is to keep the allocation between 3 to 5% of your portfolio in Palantir and to buy in very small batches every time the price falls. The current price point is actually a decent entry point, and you should fill at least 10% of your allocation now if you're willing to buy Palantir. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there. This money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.